Hello everyone, welcome to our channel. Today we're going to be talking about one of the most significant events in the history of the technology industry, the dot-com bubble. Background: the dot-com bubble was a speculative period in the late 1990s and early 2000s when the value of internet-related stocks soared to unprecedented heights. During this time, investors poured billions of dollars into internet-based companies, many of which had no revenue or profit. The dot-com bubble was characterized by excessive optimism, unrealistic expectations, and a frenzy of investment activity. Causes: there were several factors that contributed to the dot-com bubble. One of the main drivers was the rapid growth of the internet, which created a new industry with enormous potential. Investors believed that the internet would fundamentally transform the way we live and work, and many were eager to get in on the ground floor of this new wave of innovation. Another factor was the ease of access to capital. During the late 1990s, interest rates were low, and there was a lot of money available for investment. This led to a proliferation of venture capital firms, which funded a large number of internet-based startups. Speculative excess: as the hype around the internet grew, investors became increasingly speculative. Many companies went public without ever having turned a profit, with investors betting on future growth and market domination. The result was a frenzy of buying activity that pushed stock prices to astronomical levels. However, this speculative excess was unsustainable, and as the dot-com bubble reached its peak, the market began to crash. Collapse: the dot-com bubble burst in the early 2000s, leading to a sharp decline in the value of internet-related stocks. Companies that had once been worth billions of dollars saw their stock prices plummet, and many went bankrupt. The collapse of the dot-com bubble had a significant impact on the technology industry. It led to a wave of consolidation as weaker companies were absorbed by stronger ones, and it also resulted in a shift in investor sentiment towards more conservative, value-based investing. Impact: the impact of the dot-com bubble was not limited to the technology industry. The collapse of internet-based companies had a ripple effect throughout the economy, as many investors had taken out loans to invest in these companies. When the bubble burst, many were left with significant debt and little to show for it. Conclusion: in conclusion, the dot-com bubble was a period of excessive speculation and unrealistic expectations that ultimately led to the collapse of many internet-based companies. While the bubble had a significant impact on the technology industry, its effects were felt throughout the economy. Today, the dot-com bubble serves as a cautionary tale about the dangers of speculative excess and the importance of sound investment principles. Thank you for watching, and we'll see you next time.